And invariably, the first data point you look at is how that strategy did in the last 1 year, last 3 years, last 5 years, and so on, right? There is this very small disclaimer at the end, which is that past performance is no guarantee of future returns, right? And actually, I think that should be the main thing, and the old return should be in small font. SEBI did a great job of introducing that disclaimer. And yet, I don't think we pay enough attention to it, right? A lot of times, we are investing into instruments, funds, fund managers, asset classes, which have performed in recent times, the recency bias. And invariably, you are ending up buying a thing which has already done its thing, right? It's moved already. And now you are coming into it. Like I was looking at the inflows that happened into Bitcoin. The amount of inflows that we got in the last 6 months or 6 months ago was much more than what they got in the collective history of the currency. Which means majority of people who've come into this currency have lost money now, right? And why did they come in? Because they were looking at past returns. I think great portfolio managers, fund managers, wealth managers look for patterns and figure out what performed in what kind of economic environment, right? So if a particular fund manager was doing really well when interest rates were low, will he or she perform when interest rates are rising is a question mark. Like, and when we take asset allocation calls, we also end up looking at what is the stage of the economy in, right? One of the things we find a lot of similarity is 10, 12 years ago when our economy was in a similar state what it is now, right? And therefore to say that maybe the markets will behave as they did then over the next few years, rather than assuming that what has happened in the past will necessarily recur. Another interesting thing that happened, especially on the back of 2021, is that everyone started extrapolating 2021 in various ways in life.